The Indian market opens higher, aided by positive sentiment from the Fed's 25 basis points rate cut. The Nifty crosses that 25,400 mark early in trade, scales 55,800 for the Nifty Bank. And we're also seeing the Nifty IT doing well as it's crossed past important technical levels.
Cohance Life Sciences dips over 5% after around 8.9% equity worth around 3,770 crores. Changes hands via block deal. Sources says that Jusmiral Holdings, an affiliate of Advent Holdings, is likely to have been the seller.
Shares of Poonawalla FinCorp surged to a 52-week high after the company's promoters complete a 1,500 crore rupee fund infusion, increasing their stake from 62.5% to near 64%.
Saregama trades higher as Nuvama retains its buy rating on the stock with a target price of 630 rupees, with paid subscription expected to be the next growth engine for the company.
Page Industries slightly lower today, down 2%. HSBC issues a reduced rating on the stock. Their target price is at 41,040 rupees. Sees limited potential from the launch of their athleisure collection, JKY Groove.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And the Fed delivered overnight what was expected. That's a rate cut. Indian markets have been on a winning streak. We're up in 12 out of the last 14 trading sessions. And the Nifty Bank, 12 and 12. So pretty good times, Mangalam, for our markets. For the time being, all the frontline indices in the green.
Good. Nigel, both the engines firing. We have the Nifty Bank, which has been doing well, the IT index doing well, a bunch of sectors doing well, plus we have the fuel of short covering as well. That may increase as we progress to higher levels on the frontline index. But as that happens, there are a lot of stocks and sectors that we have to discuss. We do have with us Lavina Cordros, who's the capital goods, logistics and utilities analyst at Jefferies, joining us now. Lavina, always a pleasure speaking with you. Just the obvious question, because over the last 6 months or so, ever since the budget was announced, seems like things are moving from capex to consumption. And with this, GST cut coming in, etc. as well, do you think that reduces the elbow room for the government to invest further in capex and add more to consumption? In light of that, how does the sector look over the next 12 to 18 months? And what do you think is still backable?
Firstly, good morning and thank you for having me. Just on your question, very, very relevant, right? So yes, post the elections last year and especially in the budget this year, right? We saw the government discussing a focus more towards consumption versus capex. So you have seen a slowdown in the capex cycle. However, you are seeing certain pockets of capex doing exceptionally well, right? So for me, if I look at the overall capex cycle very top down, you have end markets of power, you have end markets of defense, which are doing extremely well. But outside of that, very fair that even if you look at the spend of the budget, right, earlier capex spend, let's say particularly between 2021 to 2024, the budgeted growth for capex was 15% above, let's say on a CAGR. And now you've come to a point where what's being discussed is a medium-term CAGR where the capex to debt, capex to GDP ratio will get maintained. So probably implying closer to 8 to 10% industry-wide CAGR. But again, like I was highlighting, if you're in the right end markets and in the right pockets, there's still opportunity to do very well on a stock-specific basis.
Hi, Lavina. Good to see you in and finally have you on the show. Well, expectation is that consumption will pick up, right, in the second half of this fiscal. That's because of GST 2.0. Do you think finally that long-awaited private capex push, now they don't have an option, they need to show the money and need to lend support. Do you think that's in the offing?
So again, very interesting you asked this question, right? So I'll tell you how I'll put it. While there's a general perception that private sector capex is not doing well, again, in private sector capex, if you look at pockets, right, power, a lot of the capacity is actually being set up by private sector, larger corporate groups, mid-sized groups, smaller groups. Housing as a capex end market is continuing to do very well, which is highly private sector driven. If you look at data centers, PLI linked schemes, again, all of over there, private sector capex is doing very, very well. There are a couple of larger corporates who have also commented that they are seeing some revival on the private sector capex side. So again, it's back to end pockets. Broader level, I think private sector capex to pick up in a very, very big way is going to take time. Because if you just think about industrial capex as a whole in India, right, A lot of that goes into oil and gas.
Oopsie.
They also require a big infrastructure push. So as infrastructure push slows down a bit, you'll find that capex in those areas will also.
All right, we're just trying to repatch that connection. It's slightly unstable, but I think we'll get Lavina back. Meanwhile, just keep an eye out on the market. Okay, Lavina, I think you're back and on a stable connection. So continue your point.
Oh, no. I was just saying that, as you know, private sector capex again in pockets is picking up. Broader based is going to take longer because, again, broader based, if you think about it, you need investment in cement, steel, oil and gas. And a lot of that also needs a bigger infrastructure push.
Got that. So let's get a little more specific then. You did say that defense is doing well over the last few years or so. The ordering activity has picked up. The indigenization theme has come by. We've seen that movement in a lot of these defense-focused stocks as well. If you had to back some capex themes from here on, which ones would they be? Would you look at domestic companies, capital goods companies? Do you look at some of these MNC conglomerates? Or, are there any other specific areas where you would, as much as individual stock names you can take, if you could give us a sense?
So I'll tell you what, I'll discuss business models here. I'm not in a position to really discuss stock recommendations. But let's say in power equipment T&D market, right? You do have companies that are present over there, like let's say Siemens Energy, you have a Hitachi Energy, you have GA Vernova T&D. Those are companies present in those sectors. In defense, you have the larger names like an HAL, a BEL, for that matter, even the shipbuilders and smaller companies like data centers and so on. So these are companies, of course, you'll have to have a look at valuations and then decide which investments make more sense than others. But you have these host of companies which are in the right end markets. Data centers is a very interesting area. I mean, in data centers, again, you have beneficiaries in your power equipment names. You also have beneficiaries in your automation names. Companies, NABB present, Siemens.
Okay. All right, Lavina, I think we've got you on a bit of a scratchy line, but thanks a lot for joining in. We look forward to having a longer chat with you in the time to come. But for the time being, we got a broad gist of what you had to say. By the way, the markets continue to hold well into the green. And now the Nifty Bank actually, from being a relative underperformer, that's leading the way. That's up a triple century today. So good going on that. Just a few trading sessions ago, it was holding below that 54,000 odd mark. And now it seems to have got its mojo back. There are shots in the system. A lot of the shots in the Nifty Bank. The FI selling has come down. In fact, you're getting the institutional number net that's been a buyer of the last few days. So that as well bodes well for the Nifty Bank. Yes, and before we slip into that short break, if our director can pull up the Nifty Bank with both the 50 and the 100-day moving average, you would see that it's crossed those important levels. So that's another thing that is causing that further upside to the Nifty Bank. After having crossed the 20-day moving average, which was about 1,000 points away from here, we will obviously, we were expecting a 1,000-point up move. So there you have it. Both the 50 and the 100-day moving averages, Nifty Bank has crossed past that. All right, we take a short break, come back, tell you more on markets and a lot of stock-specific action. Stay with us. 96 points for the frontline index. The Nifty Bank doing a lot better. We have the mid-cap end of things looking a lot better as well. For the second day running, nearly 2 stocks advancing for every stock which is declining. So market looks good. The question is, how much more? Sachidanand Thekar of Trade Bulls joins in for a quick technical check on the market. Sachi, we were, wondering whether there would be some recovery that would happen. Slowly and steadily over the last 10, 11 sessions, we've put on a near 1,000-point uptick from the lows that we saw, just before last week. So do you think it will accelerate from here on? Or do you think after this 1,000 points, there is consolidation likely in a 200, 300-point band? Are there any important levels you're looking at?
Good morning, Mangalam. Good morning, Nigel. Clearly, the market has been performing well, but it has been a very gradual, steady up move The rotation has been really healthy. We have the Nifty IT also contributing now. So I think from a momentum perspective, this particular move may extend towards 25,620 is what we are observing right now. Even if we see a decline, I think the supports are well established at 24,840, 880 kind of a zone. So until unless the Nifty trends above this, the bias for the market remains on the positive side. Even from a momentum perspective, the ideal stop loss level can be placed at 25,340 on a closing basis. The gap up that we have seen is very significant because we have the Nifty IT, Nifty Bank, and a lot of other pockets have also started performing. So I think it's a very steady, healthy up move, which may extend towards 25,000. 550, 620 kind of a zone during this particular series itself. Post that level, we do expect a kind of a consolidation, but as of now, there are no signs of any weakness or exhaustion. So probably we may see this gradual up move getting continued in the Nifty.
Got it. Okay. All right. What about individual stocks? What's in your radar?
Good morning, Nigel. Nigel, Adani Energy Solutions did display a breakout from a falling channel sequence. Now, if you look at the price action, it has already exhibited fresh signs of an impulse getting developed. If you look at the way its 200-day exponential moving average is placed, which is placed at around 850, there's also one more hurdle at 860, where its 50-week exponential moving average is placed. But if you look at the overall sequence, this looks like a classic fresh bullish impulse unfolding. We have the weekly RSI giving a positive crossover after a while. So we are expecting that this particular rally may see a good amount of momentum, and we may see this move getting extended towards 896, 900 kind of a zone. So we are recommending building long positions in Adani Energy with a stop loss at around 822 on a closing basis. The other stock which has hit our radar is Oberoi Realty. Even here, if you look at the immediate data, we have seen a consolidation base somewhere close to around 1640, 1660 kind of a zone. It looks like a classic double bottom formation, which we may see unfolding soon, and the price targets are placed somewhere close to around 1750 on an immediate basis. Even here, the 50-day exponential moving average is placed at around 1680. So this is the immediate hurdle. The moment we see this particular level getting surpassed, we may see very strong short covering move unfolding in this particular counter, which may push the stock towards 1830 eventually. So we are recommending building long positions here in Oberoi Realty on the futures. The stop loss can be placed at around 1662 on closing basis. The first target would be 1750. Second target would be 1830.
All right, Sachi, thanks a lot for that. Adani Energy Solutions and Oberoi Realty are the two stock picks for today. With that, let's get you some more ideas for profit. Our colleagues from Money Control Pro standing by. Kanchi Shah has a stock. Kanchi.
So the company that I've picked up for today is Hero MotoCorp, which is India's two-wheeler leading manufacturer. So several factors make us positive on the stock. Firstly, the demand in the two-wheeler and the motorcycle segment remains strong with the festive season in full swing. Also, the recent GST cut from 28% to 18% should further boost the volume. With Hero products, prices are expected to decline between 5,500 to 15,500 depending on the model. The rural demand, which is a key growth driver, has also been doing exceptionally strong. Hero is also accelerating its premium portfolio with aggressive new launches, including 2 upcoming products in the 125cc segment. At the same time, its electric vehicle business continues to gain traction. So the EV push is delivering results, with the market share rising from 4.7% in May to 7.3% in the first half of September, which is reflecting increase in customers' acceptance for their EV products. So the company's global business has also shown strength, recording a 27% year-on-year growth in the Q1. So this adds to diversification and enhanced long-term earning visibility of the company. On valuation, the company's stock trades at 87 times FY projected earnings, which we see as reasonably valued compared to the peers. Supported by strong demand tailwinds and premiumization and EV momentum, I think that the investors can accumulate Hero MotoCorp for long-term gains perspective.
Thanks, Kanchi, for joining in and explaining that to us. For the time being, we'll slip in a short break. Come back, continue to focus on markets and on individual stocks. Don't go anywhere. Welcome back. Let's focus on Hindalco. Well, the stock's in focus following a fire incident at its US-based Novelis plant. Now, on September 16th, a fire broke out at the Novelis facility in Oswego, that's in New York. Fortunately, no injuries were reported either from the fire itself or during the firefighting effort. So that's good news, right, from a humanitarian perspective. The production, though, at the plant is currently halted, with the company now investigating the cause of the incident. Importantly, the plant is insured. So that should give shareholders some kind of comfort, which will cover both the property damage as well as the potential business interruption losses. However, the impact could be rather large, going by the size of it, because the Oswego plant accounts for a little more than 10% of Novelis' total production capacity. I was just looking at what all is available on the website. It appears the plant is close to 400,000 odd. And importantly, it's one of the key sites for manufacturing high-margin automotive business. So, because of that, it could be accounting only for around 10% of the total volumes, 10 to around 14%. That's the broad range. But otherwise, profitability could get hit because it has exposure to the high-margin automotive space. So keep an eye out on the stock. Explains why the stock is a little under the weather. As it is, Q2 should not be great because they're going to be having the impact of higher tariffs that will hit, but that's already guided for. So keep an eye out on this development as well.
All right, take that point. Nigel, thanks a lot for that. Temporary disruption out there at this plant because of fire. Good part is no one is hurt. Cohance Life, that's the stock on our radar. Saw a bunch of big blocks this morning. Vivek joins in to tell us more about the participants in that large trade and importantly, what further. Vivek.
Well, that's right. So, Cohance Life Sciences, what we are tracking is two separate pieces of news flow. First up, last evening we mentioned that there could be close to 5.1% equity stake that could be sold by the promoter, which is the private equity Advent International. But today morning, what we learned from our sources is that the particular block deal size was actually upsized to close to 9% of the total equity, so amounting close to $350 million. The promoter, P. Advent, remember, Cohance Life Sciences is actually the merged entity of Cohance as well as Suven Pharma, both of which were earlier controlled by Advent International. Now, this is the combined single CDMO entity. Now, along with that, CNBC-TV18 also exclusively managed to go ahead and get access to the Form 483 that was issued by the US FDA to the company's Telangana facility. There were 6 observations of the Form 483, something that the company had intimated the exchanges. The details of the Form 483 are as follows. The first observation reads that there were failure to review discrepancies. Also, written drug record complaints were not fully followed up. Along with that, quality control unit procedures were not fully followed. Equipment as well as utensils were not maintained well. And along with that, lastly, test method accuracy not established. Slightly tricky observations. It will be interesting to see whether there is a further update in terms of either an inspection or some relief coming in from regulatory headwinds. The block deal overhang as well as the Form 483 is something that is weighing down on the stock price today.
Take that point. Thank you so much, Vivek, for explaining the reasons why Cohance is in focus today. With that, we are out of time on this edition of Chartbusters. Stay tuned. All the 4 indices up and about in the green. The team of Trading Hour takes the market action forward.